Hi there, and welcome to Track. It's Rob McGregor here. It's the 24th of March. It's 8:30 in the evening. As I record this, and we've got all the numbers up to the end of revenue right up to the minute, because there's a lot going on. Obviously, the number one topic is the Iran war and everything that's happening from there. Before I dive into that, just the usual warning. Everything in this recording is general advice. That means you shouldn't act on it without getting advice that's specific to your own circumstances. So let's dive in. We're going to look at all the important news. Everything is focused around this war at the moment, rightly or wrongly. In many ways, it's overplayed, but it's also quite important as well, particularly around interest rates and things like this, and clearly the oil price and what you're seeing at the Bowser. I'm always reminded, I updated my quote this month, Warren Buffett's great quote: be fearful when others are greedy, and greedy when others are fearful. There's a bit of fear in the air at the moment, and it's unusual because it's happening when the market's running down 7 to 10%, which is not that large, and I'll put into context for you in a minute. So let's go through that news and the big news, which February 28th, right at the end of last month, US and Israel started their war on Iran with the goal of making sure they do not develop nuclear capability, nuclear weapon capability, that is, and making sure that that was going to be, and they probably had a goal of knocking out the leadership and hoping there would be a regime change that might be favourable to potential democracy in Iran. Not sure that's going to happen, but yeah, we'll get into some of those bits now. Last week, the Reserve Bank met and lifted rates again. So when we go across to the numbers here, we'll see that the RBA cash rate is now 4.1%. There's 2 hikes in 2 months, so up 0.5% in the last 2 months. That's pushed rates up across the board. But the real increase in the 10-year bond rate is driven by the rise in oil prices and the potential for inflation. So see the chart on the bottom of this page, the black and the green. You'll see the price spiked from down around $60 US a barrel to up to about 110, and it's back to about 100 as we speak. So it's backed off a bit. There's some potential positive news coming out tonight about potential negotiations to finish the war in the next 5 days. It's completely mixed, like everything Trump and the Iranians, so it's hard to know what's going on. As I always say in these crises, the best minds in the world on this sort of stuff, they will solve it. It's not up to us to try and predict it, but it's to make sure we plan well through it and we don't make mistakes that will cost us money. So one of the positives going into this crisis, if you want to call it that, company profits, economic growth were all traveling pretty well. So that puts us in a good starting position, and markets weren't too elevated. You get this sort of crisis when the markets are in a crazy boom, it can lead to much bigger downturns. Like I said, only 7 to 10%. Everyone's worried about inflation. You see the Aussie inflation one was still stubborn around 3.5%. That's why Michelle Bullock and the RBA are lifting rates to sort of break that inflation, and their cause has not been helped by this big spike in oil price. The worry will be that this gets into the price of everything. Oil feeds into transport costs, which feeds into the costs of everything that we buy pretty much, from food to services to almost everything to manufacturing. Oil has a component. Ironically, it's less than it was back in the 70s. Some people will have flashbacks to the 70s when we had an oil crisis that led to 20 years of inflation, but we didn't have the same circumstances then. The oil price went up much, much more. The world was way more reliant on oil, and there were many other factors that were different. Inflation was already at 6 or 7% when that oil crisis started back then, and the Federal Reserves around the world, the reserve banks around the world, did not have the same power and capability that we have now. So they didn't really act until the 80s, which is why inflation was so long back then. So as much as some in the media are trying to make it look like a replay of that, it's not even remotely the same, except for the fact that we've got the skirmish in the Middle East and oil prices on the rise, but everything else about it is different enough. Now, make no mistake, if it prolongs out for longer than 3 to 6 months, inflation will leak into prices, but all the Federal Reserve banks will be tightening rates. That's going to hurt and put it down. But I don't think that's the likely case. I think we get a resolution hopefully sooner rather than that. And maybe I'm being an optimist, but I think it's based on a bit of reality as well, which I'll talk about. So all eyes are on that oil price. It's come off. It peaked at about 118. It's come back to about 100. So market's saying, well, maybe we've seen the worst of this, and maybe what then really saying is maybe there's a resolution in sight. So that's where the bets have been placed. So the big question there, as I've said, is will this be short-lived? The original target of this mission was about 4 to 5 weeks. We're sneaking up to that now. If this was resolved in the next 2 weeks, it will still be a short, sharp result. Heaven help us listening to Trump rave about that. But it would be a good result if it was over quick. The oil price would drop, share markets would boost back up more than likely. And we'll all forget about this within a few months. That's scenario one. Scenario two would be it takes a bit longer. That's in the 2 to 4 months sort of window. Inflation lingers on a bit longer. Countries put up interest rates a bit in the attempt to not have it feed into too much inflation, but it would naturally feed into inflation. But then they don't want that to feed into wage costs and the spirals and that type of thing. And the third and more dangerous scenario is that it takes years. That's very unlikely. And I'll talk about why I think it's unlikely. Firstly, we've got a massive imbalance in terms of the power here. The US and Israel have not put boots on the ground here, nor do they want to. They want to basically bomb Iran into submission. Iran's being very stubborn and not playing the game. And that's understandable as well. They have this power over the Strait of Hormuz, which controls 20% of the world's oil. And that's what's causing the grief. If this was another war, and take the Ukraine-Russia war, it has had almost no impact on the markets for the last 3 years. It went down a little bit at the start. People worried, but then everyone forgot about it. Because oil wasn't involved, because this one involves oil, it feeds into everything, everywhere. But there's a lot of motivation for the US to solve this, for Trump in particular. Trump does not like seeing markets go down. It does not like seeing things like inflation, because that's not very nice for him politically, not necessarily for him, but for the midterm. So the US has a rotating, they have presidential elections every 4 years, but then they have midterms where half of the Senate and half of the House get re-voted in. So if this was still going in 8 months' time when the US midterms are on, it's highly probable that the Republicans would lose power and make them a lame duck for the final 2 years. Now, some people might say that'd be a good thing. Trump can't do much, but it makes for a clogged up government. So now Trump does not want this. He does not want high inflation. He does not want high petrol prices as that comes up. He also ran on the basis of not taking the US into wars overseas, like his predecessors in previous Gulf wars and the like. So, his popularity's dropped, and he's very conscious of this. If he can get a victory, his popularity will spike, and he will see that he's got more chance for his side, the Republicans at the midterm. So I think that's going to cause the US to be very pro getting this solved. The Gulf states, Saudi Arabia, etc., UAE, they will define a resolution as that ships can take oil through the Strait of Hormuz, as well as other goods that go through there. So they want the satisfaction of that's done. Trump just can't walk away from this and leave the Strait of Hormuz blocked. It's in the interest of the international community, so you're going to see a lot of pressure put on for a resolution here, and it is the most likely outcome. Doesn't mean it's the only outcome, but I think it's the most likely outcome. There's talks about tonight, about talks in Pakistan in the next few days. It's hard for the US to have people to negotiate to, because they blew them all up. So the previous leaders are all gone, so they're trying to actually establish, well, who are the leaders that can negotiate on behalf of the country, while the army's effectively in charge. So it's going to be precarious. But what they want is to know that no nuclear weapons can be built, to know that there's no enriched uranium left in Iran, and that the Strait of Hormuz is a So that's the mission. Hopefully we'll see that in the next few weeks. At the very least, the next few months. And that would be something we'll forget. Now, it's interesting, down 7 to 10%. The media is making this feel like a really big crisis, but it's just not, and put in perspective. So when we look at, and I'll come back to the returns in a minute, when we look at the last 20 years, which I always show, there's been not 7 downturns more than 12% since the GFC. This downturn right now is at 7 to 10. So it's not even at 12. So it wouldn't even fit this list. Maybe it gets there, maybe it doesn't. It peaked at 10 yesterday and it's come back a bit. At the moment, it'd be only down 7%. Now, we went into this with solid returns. So returns, and look at those returns, the 10-year numbers, so the high growth about just over 10%, the growth about 9.5%, the balanced about 8.66. Really good long-term numbers, great over last year and 3 years as well. So good numbers all around that allow us to plan for your long-term financial needs. So these numbers will be hit a bit this month, but not that much. 7% is not huge. To put it in perspective, as well as that chart, we did some research and put together a few slides here to get this in context. So we asked the first question, the market's 7% off its recent peak. Historically, how big or small that is that in terms of what I would call the intra-year dips? So in any 1 year, we will have dips, and the average in the S&P 500, the US market, for the last 50 years, the average intra-year dip is minus 13%. And that's while the average annual return is 13%. So this at 7% isn't even average. Now, obviously, there's some bigger numbers in there that bring the averages up, but this is below average in terms of severity. But the world feels like it's an above average downturn. Now, in the last 50 years, 41 of those were positive, 9 were negative. And in the last 50 years, when the market was down 7%, in 33 of those years, it still ended up for the year. And that's a high possibility for this year as well, if this is resolved. So that's an overwhelming majority. That's the last 50 years. The green's positive, the red's negative. So the positives far outweigh the negatives. And then we asked the question, so when it was down 7%, how often did it go to 10%, to 15%, to 20%, or to 30%? And you can see the numbers there. So in 26 years, it got to 10%. 10% is what we talk about as a correction. So 10% of the times, so 26 out of 42 years, 62%, it got to down 10%. But in 17 of those years, it still ended up positive. 9 of those years, it ended up negative. I'll look at those 9 years. So then you'll see that come down over time. So only 15 got to 15%, 7 to 20, 4 to 30%. And in nearly half of each of those ones, the year still ended positive, even though we had a downturn. So almost impossible to make good timing decisions on these things, particularly when you're reacting to fear, because you're not always getting out. It's better. But these things react quickly. So then we looked at, okay, for those 9 years where it did end up negative, so we got down 7%, still ended up negative, what happened in the next 3 years? And in all bar one of those, the markets were up substantially over the next few years. The last Gulf War, 1990, down 3% for the year, up 54% in the next year. So the only time the markets were not positive over 3 years, this is the US. Australia was different, by the way. But this was due to the big .com bust, where tech stocks went down about 80%. Share markets in the States down about 50%. Australia did not have a tech industry, so we went down anyway over that time. So the moral of that story is what goes down eventually goes up, and 7 to 10% is not very big. So don't let the media fool you and think this is a major financial crisis. It's barely a correction, and a correction is always healthy. Bond yields have spiked, as I said, so about 4.2% in the States, about 5% in the US. We don't like seeing bond yields goes up. It makes everything else less valuable, just the way things are valued. And it's always a useful sign to see markets. When we start to see resolution here, we'll start to see these bond yields fall a bit. And they're often seen as long-term view around inflation. We've got the government, so Albo's got a conference coming up on Thursday to talk about the fuel crisis and to to work out with the states how they're going to manage that. That's a good thing. They need to be doing that. I don't think Australia's in great trouble in terms of fuel supplies. I think they'll be there. We might have a few. We might have to do a bit of work to make sure we don't have any major stuff, but we're not as bad as some Asian countries that are going to see rationing and potentially price controls and these things. But I put this in because it's interesting. Chalmers has said that Treasury modelling shows that Australia's inflation could reach 5%. Now, why is he doing this? Partly because he was being blamed for inflation being high at 3.5% because of the spending the government's done. So he's now seeing this as an excuse to say it's not me, it's the oil price and the war. He's got a budget coming up in May where they need to do a lot of stuff to reduce spending, but tax reform and stuff and things as well. So he's going to use this as an excuse. Treasury model 2 scenarios, one $100 a barrel for the first half of the year, then dropping, the other one $122 a barrel for the first half of the year, and taking 3 years to come back. Now, I'm not sure why Treasury model it like that. Like I said, we're talking 3 scenarios, but if it's over quickly, this will be forgotten quickly. If it's medium term, we will get these numbers that Treasury is talking about, 4 to 5% inflation, and that will be high interest rates and potential slowdown in growth. So, but that's if it takes a bit longer, and if it takes a really long time, then that's even worse. But like I said, it's unlikely to. It's in the world's interest to resolve this. The Gulf states are pretty united here, which is important. So it's not like we're going to have other Middle East countries joining in to support Iran. So that's a positive. And they're highly motivated to resolve it, as I said. At the start of the year, I did the 6 tailwinds, 6 headwinds, 6 potential black swans for the year. So as I update those, one of the tailwinds was easing interest rates, lower interest rates. Right now, that's off the table. It's gone the other way. So that's one tailwind less. All the others are still good. Resilient global growth, plenty of spending around AI and CapEx, plenty of fiscal support, so government spending, household and corporate balance sheets in good shape, and emerging markets benefit. They're all good. Emerging markets might do a bit tougher with fuel prices. They're more dependent on it to some degrees. The headwinds, the Mag 7, so the top 7 tech companies have come back, so that headwinds that's a good thing. That to take away a headwind is a positive. But yeah, the one that's elevated is the geopolitical noise, and in particular, one of the potential black swans was a major geopolitical event, of which you'd probably call this one, and central banks forced back into rate hikes, which is happening. So 2 of those black swans are playing out. They're not huge yet. They probably won't get huge. It's always possible, but not probable. And I'll just talk about wars. Wars in terms of economic activity and the eventual market impact are actually positive. And I'm not trying to diminish the humanitarian horrors of war, none in the least. But when I look purely economically, what does a war do? It destroys a lot of property and infrastructure, all of which has to rebuild, which is economic activity, which is positive for market. It blows up a lot of guns. It sends a lot of people around. All those things are going to be replaced and moved back. All of that is economic activity, which is good for markets. Most people don't realise, but during World War II, share markets went up, driven by the extra economic activity that war brings. So yes, humanitarianly terrible, but economically not so bad. And that money will be spent, and that will help eventual recoveries. We have the market at a 9. The investment committee met last Thursday. We dropped from a 10 to a 9. We've got the ASX 200 valued at about 8,200. So that, based on what's happened since last week when we met, we might even have that market at about an 8. So it's getting closer to fair value. That means it's good buying at that level. It's not quite there yet, but it's just in that fair to expensive range. But it's dropping as we speak. Once again, if this is short-lived, we'll probably see markets bounce back up fairly quickly. In the mess it up section here, I've lit up the first 4 here because all of this, there's no greater example of the media doing its thing at a time like this. The media loves a Middle East war because it's got everything going for it. There's religion, there's there's oil prices, there's inflation, there's the threat of everyone joining in. The media loves this, so they're making you fearful, or not necessarily you, but lots of people fearful. That's the emotional side. And like I said, this is a 7 to 10% downturn, but it feels like a bigger one, but it's just not. Now, that's because of the short-term focus they're looking at here and the single issue obsession. We're seeing this dominate the news completely, and this too shall pass. In fact, the bias that I've stuck with here for this month is recency bias, which is the behavioral bias that makes current news seem way more important than it will end up being historically. So we forget about these things. This is not the first Gulf War. This is not the first blockade of the Strait of Hormuz. They do pass. Iran's probably as weak as they've been. Well, weak enough that they will want to work through this. Who knows how stubborn they are? But as at the time of recording, and it might be totally different when this is sent out to you tomorrow. But at the time of recording, there's a little bit of optimism around a potential resolution. So hopefully that comes out, and by the time we're talking next month, it would be nice if that was resolved. Now, it may take longer. I'm not a delusional optimist on these things. It may take a bit longer, but I don't think it takes. I don't think it takes multi-years type of thing. Our process is designed for the normal and inevitable volatility that is the share market. So this is nothing. This is never unexpected. The exact version of it is never something you predict, but normal, like I said, every year the market goes down 13% on its way to being up. Sometimes it's down a bit, it's not up as much, sometimes it's up a bit more, but there's downturns every year that in the last 50 years have overtaken 13%. That gives an incredible amount of opportunity for rebalancing. And to explain rebalancing, I always explain a simple thing that happened in COVID when markets did go down 36%. A lot more than 7. When share markets go down, rebalancing means we sell some of the conservative investments, call it bonds, and we buy shares. And the market goes back up, we do the opposite. So we get to buy shares low, sell them high. So it means every downturn we make some money from rebalancing. So it's a good thing for the longer term return. The biggest job for us during these times is managing our clients' behavior, which means making sure they don't make bad decisions and all those ways that we said. We know that volatility is inevitable, certain, it's unpredictable exactly how it plays out, and it always seems scary at the time. I do know that for our clients that have been invested for a long time, it's of our clients going back coming up to 30 years that they worry way less than people do. That's normal. And the most important thing always is managing liquidity. If you help plenty of liquidity through the reserves and backup funds, you never have to sell at a bad time. So let's have a look at some of the charts in particular here as I go through. And if you look at the top right-hand corner of all these charts, you'll see that downturn. But you'll notice it hasn't given up the whole year's worth at all. It's down, but it's not out. That's Aussie shares. US shares the same, down but not out. Global leaders down but not out. It's just a correction, and in fact, it's not as big as the correction that we had last year that we've all forgotten about. Almost. That was the Trump tariff tension. So good returns still flowing through the correction. US small caps, less down, and emerging markets less down. They both had good years, 30% in February for emerging markets. Gold's been a funny one in this downturn, and it's almost not very rational for gold. Normally in a crisis, gold goes up. But gold had gone up so much in the last year that it's turned around a little bit, and that's caused hedge funds to start having to sell all the leverage positions. So it's having a break. It's going to be interesting to see whether that stops and whether that spikes back up again to close it out. A bit less on property today because I want to spend more time on the Middle East crisis. But property is also affected by interest rates. We've had 2 hikes now. So mortgage rates are up 0.5%. That's going to slow up people a little bit, but we still have the same problems of not enough supply of good property. So none of those problems are solved overnight. So while we might see a bit of a slowdown, it's certainly not a disaster with property because we just don't have enough. Last year, we still see returns ranging from 3.4% in Melbourne to 19.5% in Perth, average of 9.1% for the country. And in the last quarter, returns have still been positive. Excuse me. Interest rates up, so you'll see the rates here from the big five, the big four plus Macquarie, pretty much all in the sixes. I know some of them still say 5.84, but a lot of the rate rises don't come in until April the 2nd. So they will jump another 0.25%. You can see the fixed rates. All pretty much with the 6 in front of it now and all fairly flat. So no real advantage to fixing rates. No substantial change to any of the property clock. There's still always good places to buy, and there's places that are more expensive if you are a seller at some stage in your retirement plans. But yeah, I'm not going to talk too much about that. This month, in the interest of time, we'll revisit that more about the next few months as hopefully the release price list wears down. So in summary, as always, all investing best done as part of a plan. Goals first, based on you and what's important to you, and portfolio design to meet those goals. And take a long-term view. And in times like this, it's really important to remember that long-term view makes you lots of money. The price you pay for good returns in the long run is occasional periods of instability like this. That is just why we get those higher returns. All the good stuff, diversification, asset allocation, liquidity, the good boring stuff, selling life and borrowing money, is what allows us to have such consistent returns over the long run, along with low-cost index funds. Most of the growth markets that protect against the short-term volatility. And we protect that through reserves. So as you know, I'm about to say, there's only 3 ways to lose money: panic and sell. The purpose of this communication is to keep you informed, so that doesn't happen. To help you manage your behavior. Never have to sell, and that's where we hold the reserves and make sure people are in for the long run and not properly diversified. When you don't do those things, when you are diversified, when you never have to sell, when you never panic and sell, you get the long-term benefit. So 10% return on shares. 7 to 8 on balance funds are good, solid returns that enable us to deliver those plans to you in the long run. So hopefully that helps ease some fears. I know for some of you that's been a thing. I know for many of you it's not, which is awesome. Feel free to talk to your advisor if you've got other concerns or short-term issues that mean you might be needing money. But all these things pass. These too shall pass, as they say. Classics. So yeah, until next time, Rob McGregor signing out.